Hello. Good afternoon, everybody. So the final budget, as we all know, is less than 2 weeks from now. So in light of that, for this month's edition of Netra, we try to delve into India's fiscal health. It's essentially a take on how India's fiscal expenditure has shaped through the recent past and how fiscal consolidation may unfold in the current financial year. So just to set some context, I'll list a few broad questions that Sahil will answer through the course of his presentation. The first question being, the budget in February particularly emphasized around capital expenditure. The question is, do we have the capacity to sustain that thrust, or rather is that push even aggressive enough to drive the growth forward? Second question, while the government has maintained undeterred focus in this space, is the CapEx even enough to pave the way for private sector to kind of crowd in, or is it even enough for private sector participation? Third question, what motivates India to maintain a high fiscal deficit? Is there validation for this approach? The last question being, and I think that will interest the most of you, how often does a strong economic growth translate into equally strong equity returns? Or does it even translate into any returns at all? So without much further ado, I will let Sahil take over. Just as a side note, you can all, through the course of the presentation, you can all put your questions in the question answer tab on your screens below, and we'll take them towards the end of the presentation. Over to you, Sahil.
Thank you, Pragati, and good evening to all of you. So today we will discuss the July edition as Pragati highlighted, and we write Netra on 5th of every month, and our endeavor is to give you views which are useful. So in the July edition, we are going to discuss India's fiscal expenditure and sort of how it has changed and transformed over the years. And that will be the key message and learning from today's presentation. But first, I think one of the most important things that we want to chat about is this bursting of this myth on how economic growth translates to equity return. So more often than not, we hear from people that because the country's GDP is going to rise from 3.5 trillion to 7 trillion, 10 trillion, 20 trillion, the case being India, when we talk about local numbers, what we repeatedly hear is that because GDP is going to grow by X%, equity returns will commensurately come. And through this slide, and similarly, we have given cuts of similar data for these 16 countries. We've given you 30-year absolute returns. We've given you SIP returns of these countries, and we've given you different cuts on how equity markets have performed across the globe. So first thing is that, is there data which can falsify this statement that if there is GDP growth, then equity returns will come, right? So if you look at the slide on your screen, you will find that the fastest growing economy over the last 30 years has been China, which has grown at 8.6%. And where real returns, which is adjusted for inflation, equity returns have been minus 3%, which is the worst, which means that the fastest growing economy has delivered the worst returns over the last 30 years. And then you come to the second fastest economy, which is India, has delivered 3.6% return. These are, of course, not the best and not the worst. These are middling returns. Of course, they are very, very good returns. 3.6% real return is a very good number delivered over the last 30 years. But two very specific case in point in this data. One is Brazil, where you see the GDP growth is only 2.4%, not very strong. In fact, if you think about it, that if India or any other country were to grow at 2.5%, what will be your expectation of equity returns, right? In case of Brazil, the returns are 9.3%, close to double-digit returns, real returns. So these are fabulous and very high returns, right? So one, there are many countries which can falsify this statement that if there is equity, if there is GDP growth, then there will be equity returns. Many countries do not follow this pattern, and therefore, when you look at data, and if there is only a single data point which does not qualify or replicate the hypothesis, then that data point is enough to falsify this theory. And we have enough number of countries which show you the same thing. Now, what is the other angle? The other angle is that equity returns are dependent not only on the growth in the economy, they are actually dependent on, are companies able to earn over and above their weighted average cost of capital? So if companies who operate in a country are able to deliver returns over and above their weighted average cost of capital, they will deliver high returns. And that is what has happened in many of these countries. Even in spite of low, high, or mixed economic growth, some countries have delivered returns. And the reason is that companies in those countries have been able to make more money and therefore deliver value to shareholders. And that, I think, is the most important aspect that you should watch out for. Are earnings going to grow? And second, and more important aspect is, what am I paying for those earnings? So if my company is going to earn, let's say, an ROE of 15%, and its earnings are going to grow at 10 or 15% odd, what should be the earning multiple that I should pay for such growth? I think this is the only question that investors have to answer. All other points, whether it is economic growth, long-term growth, policy making, everything else is a supportive factor or it could work against, but it does not translate to equity returns. So this, I think, is a very important aspect which investors should not miss. And every time, anytime you hear from anybody, including us, that you should invest in XYZ company only because Indian GDP is going to grow from 3 to 10 trillion or 15 trillion, please remember that it is not a sufficient condition. It needs many other conditions to be fulfilled. And the two most important ones are whether the company earns a decent return over its cost of capital, and second, whether it continues to do that over a very long period of time. And what is that you are paying for that earnings, which is a P multiple or price to book, or however you judge that multiple, or what is the valuation of the company, right? So this is our first important piece of information. The rest of the deck is on, as I said, metamorphosis of India's fiscal expenditure. A lot of people have repeatedly spoken about India being one of the fastest growing economy in the world. So I will show you some data points on how India achieved that post-COVID. What did we do right? So first thing is that if you look at the data on your screen, it shows you a number of dots and arrows. The blue dots here is the average of 2015 and 19. On the vertical scale is the budget balance, or what you usually call fiscal deficit or surplus, which means that when the government borrows money, it is called a fiscal deficit. It borrows money to spend. That means its income is lower than its expenditure, so it has to borrow money. So in most countries, that is the case, right? That governments have to borrow money by issuing bonds, and the vertical axis is how much are they borrowing as a percentage of GDP, and the right axis is the real GDP growth rate. How faster is the GDP growing? So if you look at this chart on your screen, it gives you one very important cut. In most countries, the fiscal deficit has actually gone up, right? So for example, the blue dot has shifted lower. You can see for Russia, the blue dot was close to zero. It shifted lower to close to -2%. In case of India, it was close to 3.5. It shifted lower to about 6%, right? So the dot has shifted lower, right? Which means that fiscal deficits have gone up. But one point to note is that in most countries, real GDP growth has not accelerated as much as it has done for India. So in case of India, real GDP growth rate, which was just shy of 6%, has come closer to 8%, 8.2%, 8%, which is a very fast growth, one of the fastest in the world. For most other countries, that is not the case. But you also see large shifts for Brazil, right? Which has gone from no growth to a decent growth of 2%, right? But please remember that Brazil and Russia are very commodity heavy countries. And the period that we have chosen at that point in time, oil prices, other commodity prices were lower, and then they rebounded post COVID. So if you nullify or neutralize the commodity price effect, their growth is very, very shallow. China, for that matter, you can see uh, the growth has slowed down, right? In case of China, India's growth has quickened, right? It has risen sharply. What is the reason? Two very critical reasons. One, as I've written in the title, there was a global fiscal extravaganza. What is fiscal extravaganza? most governments across the world decided to spend money on through their own budget. So when COVID happened, most governments said that citizens or people of the country are not able to go to work and earn a livelihood. So the government will borrow money on its own balance sheet and spend that money and increase fiscal deficit, which means that they are borrowing and spending money. And why did this fiscal deficit go up? Because government's own income, which is taxes, went down while its expenditure went up, right? So everybody in the world did the same thing, and India also followed. India also did the same thing, and that's why you see fiscal expenditure went up. But most countries was not able to spend this money in a fashion that led to a stronger growth outcome. And India was able to do it, and that has showed up in India's growth. And as you can see, that growth has gone up significantly. So first conclusion from this slide is when the world was spending money, world across the world, governments were spending money to revive growth. India also did the same thing, but India was able to do it better. Please note that for India, the doing better is a policy design implementation, but it is not a policy, right? So when the whole world was spending money, India also had to step up and spend because we were facing a crisis, and therefore the ability to increase our fiscal deficit was given to us because our trade partners were also doing the same thing. Had they chosen not to do it, for example, had US said that let COVID settle down, I am not going to spend money, I'm not going to increase my fiscal deficit, many other countries, including India, also would not have been able to do the same thing, right? So the expansion in fiscal deficit is a global phenomena, and it was made possible because most countries chose that path, and that allowed India to do the same thing. Second, very similar example, as I told you in the last slide, because US ran a very large fiscal deficit. You can see this data we have put from 1991. Post-COVID, US borrowed a lot of money. And this allowed India also to borrow a lot of money so that our currency does not suffer. Okay. So what is the opposite that could have happened? For example, India decides to expand its fiscal deficit. That means government says that I'm going to borrow money and give it to people because during COVID there is a lot of hardship. But US says that I'm not going to do the same thing. I'm going to wait. In that case, rupee would have depreciated. We would have got a lot of pressure on our balance of payment. We would have got a lot of pressure on our bond yields. That means bond yields would have gone up, and RBI and Government of India would have to solve for it by introducing more stability measures or capital controls, etc. But none of that happened because US, which is US and China and other countries, which are our large trade partners, also spent a lot of money doing the same thing. So as I said in the last slide, this is a global policy phenomena, and India got the benefit of doing the same thing. In hindsight, it looks like a benefit, but the most important point is India was able to do it better than most other countries. Now, I will introduce two terms. One is counter-cyclical policy and the other is pro-cyclical policy. They appear slightly more jumbled up, but they're very easy to understand. And I'll give you an example. On your screen, you see two slides. One is the real GDP growth rate, which is in the black line, which is going up and down. The other is the blue line, which is the gross fiscal deficit, right? And the middle two black and blue lines are the averages of these numbers. Okay. So when the black line is up, for example, look at this phase, where for 4 5 years, these are 2 year averages, right? So for about 4 to 5 years, India's GDP growth rate was very high and our fiscal deficit was falling. So when the economy was doing very, very well, the government was not spending money. It was actually reducing its expenditure as a percentage of GDP. And this is what is called counter-cyclical policy. So the government is spending less when the economy is doing well. And the reason is because the economy does not need government support at that point in time. And then global financial crisis happens, right? India's GDP growth declined significantly. So did the rest of the world GDP growth. And in response, the government of India spent a lot of money, introduced what is called fiscal stimulus or government stimulus measures to bring back the economy and accelerate growth. Okay, this bringing back or this spending when it is required or when spending, when the economy is slowing down, is called counter-cyclical policy, which means that government of India or the policymakers are acting in opposition to the economic trend, which means that if economy is slowing, the government wants it to revive, so it will spend more money. This is called counter-cyclical policy. What is pro-cyclical policy? Is when government spends money when the economy has already revived or is already doing well. Okay, or it reduces its expenditure when the economy slows down. That is called pro-cyclical policy. A counter-cyclical policy blunts the economic trends, which means that if the economy is weakening, it is slowing down, and government spends a lot of money, the slowdown will become shallower or the economy will turn around. Okay, this is counter-cyclical. If the government spends less, if you remember, there were crises in Greece and other countries where the government was forced to cut down its spending. That is called pro-cyclical policy. It prolongs the pain in the economy. Now, why did I explain these two measures? So if you can see post-COVID, the government of India introduced a very large fiscal stimulus, right? Like all the countries in the world did, and India's growth also rebounded. Okay. But then the growth has been more sticky in the last 2 years, while the fiscal deficit continues to remain above its long-term average, which means that government of India did extra expenditure, although India's growth rate, not the absolute amount of GDP, but growth rate had revived to pre-COVID or even better averages. Okay. So this sort of counter-cyclical policy, which was instituted during COVID, became pro-cyclical, that even when the economy had revived, there were still extra expenditure being made. And this policy, which has been favorable for economy to do well, in the next 2 years could actually turn more adverse. Okay, what do I mean? And this, I think, is the most critical point of the whole presentation, that government of India, because the way that the budget is and the way revenues are, might choose to not spend a lot more money and choose fiscal discipline or fiscal consolidation. In simple terms, it might choose to borrow less money and spend less money when the economy is actually going to slow down. What does slow down mean? From 8.2% where we are right now, one of the fastest growth that we've seen for a very long time. If we slow down to 6.5%, which is what the RBI is projecting, during this slower growth phase, which itself is one of the highest growth rates in the world, the government's contribution will not be very high. So it will reduce its expenditure at a time when the growth is also slowing. And why will it do so? And why it has been able to do so, I will explain to you in the next few slides. First, I will make the point how Government of India achieved better efficiency in expenditure over the last 3 years, which means that it did a lot of expenditure in on infrastructure, etc. So when you look at Government of India expenditure, it is divided into two parts. Okay, one is called revenue expenditure, the other is called capital expenditure. Revenue expenditure is on items like, let's say, salary, or it is more like an operational expenditure, which keeps the lights on, the engine running. Capital expenditure is the more productive expenditure, which is, for example, spent money on creation of fixed assets, which is roads, railways, ports, houses, etc. Right? So capital expenditure goes a long way in supporting economic growth, while revenue expenditure is more like carbohydrates, keeping the body running. It has some effect on the long-term growth, but not a lot, right? But revenue expenditure is a massive share of government expenditure. So, for example, if you look at the data on your screen, um, Government of India had to spend a lot of money on subsidy. So if you look at this bar, in FY21, Government of India spent a lot of money on food, fertilizer, and fuel. Okay, which is the blue bar you can see, because a lot of people were out of work. There was a lot of hardship. FCI borrowing was there. Uh, Other rural agriculture schemes had to be given a lot of money. So our subsidy bill zoomed up as much as about 5% of GDP, which was very, very high. But subsequently, you can see our subsidy bill has fallen, right? Over the last 7 to 10 years, after the deregulation of petroleum fuel market, that subsidy has gone away completely, absorbed by the citizens directly. The expense has been borne by the citizen directly, and other subsidies have also not grown significantly. So the government spent less and less money on revenue expenditure, which gave it the ability to spend more money on capital expenditure. And what is capital expenditure? I explained to you the expenditure which is done on roads, railways, ports, houses, etc. And I will show you what that capital expenditure is as we go ahead. This slide has 4 charts and all of them are very, very important. And one of them, which is the critical one, is the first chart, which I will, sort of expand for you so that you can focus on it. So if you look at this chart, it has 2 lines, revenue expenditure and capital expenditure of Government of India as a percentage of GDP. You can see that capital expenditure has gone up significantly. Over the last 5 years, it is now at 3.2, 3.3% of GDP, a very high number. This number was, lingering around less than 2%, between 1.5 to 1.8% for almost 10 years. Post global financial crisis, it did not go up. And post COVID, this number has jumped really high, right? And at the same time, you can see the blue line falling after the initial jump in 21. The government has not spent a lot of money in revenue expenditure. This also tells you why consumption growth has been weak, while gross fixed capital formation in India or capital formation has been very strong. One reason is government has spent a lot of money. You see this similar trend played out in 2003 to 8 cycle, where capital expenditure was very high. And even at that time, revenue expenditure, although was very high, was coming down. Slowly and steadily, it was coming down. And that time also, India's rupee became strong, oil prices were stable, inflation was stable. So government of India was able to spend a lot more money on capital expenditure. But the divergence that you're seeing, this is the first one. And by choice, the government chose to spend more money on capital expenditure, which translated to stronger growth. So this is fiscal spending when the government spend money on final consumption, which means that its own expenditure, or on CapEx. It completely translated into growth post-COVID. You can see it added to GDP growth rates completely. So the efficiency was very, very high, right? Now, how much did it spend? This, I think, is a very, very critical question. And we thought about it very deeply, that how did this change come about? What is the magnitude of change on capital expenditure? So if you look at Government of India's expenditure, if you look at the last column, prior to COVID, we took the 10-year average. So if Government of India had 100 rupees, it spent about 87 to 88 rupees on revenue expenditure. What does revenue expenditure include? I told you earlier, it includes salaries of, let's say, law and order, police, IAS officers, all the operational departments that Government of India runs, all the subsidy that Government of India gives, all of that is revenue expenditure. So it used to spend a lion's share of its money on revenue expenditure. And on capital expenditure, the spend was 13-14% out of all 100 rupees that it earned, right? Whether it had borrowed or earned that money. Post-COVID, it spent 32.3, almost 1/3 of its resources that it mobilized post-COVID was spent on capital expenditure, which is a very large jump, right? A big jump in expenditure by Government of India. And what was the magnitude of this jump? So just imagine that Government of India had followed what it was doing pre-COVID. It would have spent about 3.3 lakh crores, 3.3 trillion rupees on capital expenditure, but it ended up spending 7.75 lakh crores, 7.7 trillion rupees on capital expenditure, and which sort of tells you, or possibly in your mind, you will be able to make out why this sector, all the subsectors in this space, whether it is infrastructure, road construction, defense, it has done so well because the number has been materially higher, right? I will talk about why this number will go up or go down in future. What are the trends saying? Where is the mobilization coming from? But first, note of caution, last 3-4 slides, I've told you what has gone well. But what is not so good in the whole cycle is that the total public capex, which means that expenditure by Government of India, state governments, and PSEs, public sector enterprise, has gone up to cyclical highs, but it is nowhere close to the previous high that we saw, right? So at one point, Government of India has done a remarkable job in increasing its capital expenditure, but the total expenditure in the economy is not extraordinary. It is not out of whack, right? For example, why am I saying it is not out of whack? because at this point in time, the market is giving this sector valuations which are similar or higher than the 2003 to 8 cycle, while the underlying spending is not similar, it is lower, right? So therefore, that is why I'm saying it is not extraordinary. Otherwise, these numbers are very strong. They're at cyclical highs. Now, the next question is, can they continue to be at these highs? Okay, what are the tea leaves that we should read to understand whether this kind of expenditure will continue or not? So for that, we'll go to the next slide where I will show you how Government of India is now pulling back on fiscal spending. Okay. First point is that do we need to pull back on fiscal spending? Okay. And that I think is one of the most important takeaways from today's presentation, which I will talk about now. Initially, I told you Government of India has been able to spend so much money because our trade partners were also spending. Had they not done the same thing, we would have also stopped by not spending so much, or we would have reduced the extent of expenditure. So, we've got this opportunity to spend money. Just imagine that prior to FY20 or prior to COVID, if Government of India finance minister, for that matter, any finance minister over the last 10, 15, 20 years had said that I'm going to run a fiscal deficit of 5% or 6%, it would have wreaked havoc on Indian financial markets. But as of today, as we speak, these numbers don't even matter, right? Even if India runs 5%, 5.5%, 6% fiscal deficit, nobody is even talking about it. In fact, when you go online, read views from various people are talking about loosening the purse strings, where they are saying that Government of India should spend more, which means that they are saying that our fiscal deficit should actually go up. But if you just reel back and go back 6 years or 7 years, if Government of India had said that my fiscal expenditure is going to go up from 3.5% to 4%, rupee would have weakened, yields would have shot up, but that is not the case today. And the point that I'm emphasizing is why it is not happening today is because our trade partners are also running very high fiscal deficit. What are those numbers? US, which usually runs 2-3% fiscal deficit, is running 6%. Similar numbers are available in Japan. Similar numbers are available in Eurozone, UK. Most countries, most of our trade partners are doing the same thing. And therefore, that channel to get that punishment of running high fiscal deficit is not there. And therefore, we have that ability. Now, question number 2, will this channel continue? Okay. Now, this is a very interesting question. I don't think a lot of people have thought about it, or they have thought about it or not written about it. First is that what if the US changes its fiscal policy? Okay, and the change in fiscal policy can happen, if the government changes in US and a new Treasury Secretary comes in and that person says that I'm not going to run this kind of fiscal deficit because it is very high. You would have seen, I have also shared online, where Jerome Powell, the US Fed chairman, has already said that US is running an unsustainable fiscal deficit and they should pull it back. In fact, in May 2024, in one interview, Warren Buffett said that I'm not worried about US debt, I'm worried about US fiscal deficit. Although Warren Buffett is not a economist, or he doesn't pay heed to economics a lot more, but even the smartest investors in the world are worried about that number. So can there be a politician or a treasury secretary in US which says that I'm going to take a step back and not spend this money? The moment they do that, all other countries, including India, will also have to reduce their fiscal expenditure. And this bazooka or this extra power of expenditure that we are utilizing will no longer be available. But even without that happening, currently what is happening is India's total fiscal expenditure is now coming down rapidly. Okay. Indian government is now reducing the fiscal deficit, maybe in anticipation of what I said earlier. And if you go back to slide number 3, where I introduced pro-cyclicality, which means Government of India reducing expenditure when your GDP growth also slows. And please understand, what does slow GDP growth mean? It does not mean that we are going to go to 1% GDP. All it means that if you are growing at 8, now if you are going to grow at 6, Government of India, if it spends less, it drags on that growth. That means it is not making that growth faster. It is actually making that growth even slower. Okay. And this will happen at a time when GDP growth rate, which means that rate of change will slow, but your absolute GDP is still below pre-COVID trend. What does pre-COVID trend mean? imagine that if no COVID had happened, our GDP would have grown to this level today, or 190 lakh crores in real GDP terms, while it still languishes at about 160 lakh crores in real GDP terms. These are not the nominal numbers that you are used to listen to, which is 300 lakh crores or $3.5 trillion. This is the real GDP number adjusted for inflation. So this slide tells you that maybe the fiscal consolidation is coming too early. Okay. And this could be a source of problem. 2 slides from now, I will tell you why. Okay. When we talk about salaries and wages, I will tell you why this could be a source of problem in terms of reducing fiscal expenditure at this point in time. Now, we will go back to discussing CapEx, which I think is a very, very important aspect, which is infrastructure. And I wanted to then, drill down and, put all the points together, which I've discussed until now. So these 2 slides will talk about two very important aspects of Indian economy. One is the total overall investments or the CapEx cycle. So when you look at the overall investments in the Indian GDP, this is the full share. This is the pie of how investments happen. It is on your screen. You will note that if 100 rupees of investments or CapEx is happening, out of that 55 rupees, out of the full 100 rupees, goes to construction of houses and buildings. Okay, this is the largest share of India's CapEx cycle or infrastructure growth, right? And the other goes to plant and machinery, or machinery and equipment, not plant, which is sort of gross block addition by corporates and public sector enterprise. The other is intellectual property, which is a smaller number. But this housing and building construction is one of the most important indicators. In fact, if you were to ask what is the single most powerful indicator or a concurrent indicator which can tell you the trend of India's economy, it is building construction, or the construction which happens from people like you and me when they build their own houses, or when builders build their houses, or when the government builds low-cost housing for other people, or it is done by other companies. This bar chart on the left-hand side, excuse me, tells you the breakup of this number, this 55%. So out of 100%, 55 comes from building construction, as I told you, houses and other buildings. This 55 is split into 28, 11, and 16. And this is 28%. What does 28% means? This is not 28% of 55, but this is 28% of the 55%. So this is 28 plus 11 plus 16 will become 55, right? So I hope that is clear. This 28% means 100 rupees spent on investments in India in any given year. Out of that, 28 rupees is spent by people building their houses. Okay, it can't get simple than that. And this is the biggest source of capital expenditure, or whatever you call it, infrastructure, GFCF investments, whatever name you give it. And this number used to be 37% at the peak of the last cycle. Our cycle peaked in FY11 and FY12. That was the best case in terms of infrastructure and capital expenditure growth. At that point, the share of households or people like us building homes was 37% out of 100 rupees. In the current cycle, when we've seen a big revival, I showed you all the revival numbers. This has not gone back to the pre-COVID levels, okay, or the peak levels. What does this mean? Even when we've seen a big revival in this sector, the biggest bulwark or biggest supporting factor of investments to GDP, which is the household sector, is still missing. Okay, it has made a comeback, but that comeback is very tentative. It is not as strong as the previous cycle. Now the question is, can it go back to that cycle? Is it a 10-year cycle? Will we see this 28 becoming 37, etc., right? So for that, we'll go to the balance sheets of households. Okay, so here I will address two things very clearly. One, households save money by two measures. One is in financial savings, right? They put money in savings, deposits, time deposits, financial securities, stocks, bonds, mutual funds, etc. The other is they create physical assets or physical savings, like money putting in housing, or real hard assets or gold, right? As you can see, physical savings for households have gone up, but it has not gone up to the previous highs. It continues to be lower than the previous highs, as we've seen earlier, while the net financial savings of households have actually declined. Okay, This might come as surprise to some of you. You would have read repeatedly in number of publications, and the financial sector is also, to blame for giving you this information, that there is financialization of savings happening. But in fact, when you look at this graph, you will see that it is actually definancialization which is happening. Physical savings are going up, and financial savings net every year growth rate has come down, and the growth rate has come down to 5-6% now. And why is this number important? This is slightly becoming more technical, but just to give you a one-line explanation, there are only three entities in an economy. In India, there are only three entities. One is households, people running their homes. The other is Government of India, including the state governments, and the public sector, which also includes, government-owned entities. And the third is the private corporate sector, which are the companies. Only three entities in India. Out of these three entities, only households are net savers. That means they save money. Government of India runs on a deficit, it borrows money. Private sector runs on a deficit, it borrows money, right? So only source of savings in the country comes from households. If household savings slow down, then the ability of the economy to do investments also slows down. Or you will have to borrow money from outside, which means that you have to seek capital from overseas. And for countries running a trade deficit or a current account deficit, it becomes a source of problem. And therefore, higher financial savings or acceleration in financial savings is a good thing over a longer cycle. As of now, that trend seems to be slightly more adverse and not progressing in the manner that it should, right? Second important thing, why will the household spend a lot of money? And in last 5 years, what we've seen that households have spent a lot of money. Okay. And where did that money come from? Largely, it is a function of increase in overall household debt. So they have borrowed money in mortgage or agri debt or business debt, non-housing debt. Total debt has gone up from 31% of GDP for households to 36% of GDP. So they have borrowed money and spent. It also tells you why in India, luxury and metro city growth rate has been much stronger than tier 2 and lower strata GDP growth rate, which a lot of people last 2 years ago spoke about the K-shaped recovery. And these numbers are visible not only in this number, which I'm showing on the screen, but even if you look at tax paid by the top 10 percentile people, it is way higher than tax paid by the bottom 10 percentile people or 30 percentile people. You can triangulate these numbers with different sources: sales of SUV, sale of houses beyond 3 crore value or 10 crore value. All these numbers will give you the same thing, which means that people who have more money, households which are fairly well off, have been able to spend more money, through their own resources or by borrowing more money. Okay, so indebtedness in the household sector has gone up, and that is one of the reasons why we have seen large consumption upticks in this part of the economy, low consumption uptick in the tier 2 and lower strata of the economy. And also, very, very important point, the question which I started this slide with, can household investments go back to the pre-COVID or peak level trend? For that to happen, households need to have better balance sheets. But over the last 5 years, balance sheets have slightly deteriorated. Although these balance sheets are still fairly very strong in comparison to many other emerging markets, but they have deteriorated. So one is the balance sheets of household. Second is, if you think intuitively, when do we spend money? We spend money when we have the visibility that our wages and salaries are going to go up. So we looked at data for wages and salaries, and you can see that if you focus on this table, you will see that top three sectors, which is information technology, financial services, and auto, is 65% of India's organized wage bill. Okay, this is also a reflection of, you could say, metro, urban, organized, top tier consumption, because as you know, the bottom consumption is still off. Those numbers are clearly visible in poor sales in two-wheelers, poor sales in small cars, lack of volume growth in consumer staples, in FMCG companies. All those numbers tell you that that part of the economy has not made a dramatic comeback, but the luxury, urban consumer, luxury part of the economy has made a premium part of the economy has made a big comeback. And this number, which is wage bill of BSE 500 growth, is also a reflection of the same thing. And also, if you look at wage growth of corporates, that also gives you the same impression, right? This is 65% of the organized overall market. How to read this? If you look at this number in totality, matlab main, if I give you the full absolute figure of BSE 500 wage bill, 500 top companies, how much do they spend on wages and salaries? That number is close to 10 lakh crores, while our GDP is 300 lakh crores, right? So you can see that it is a very small number. It is just about 3%, right? So this is not representation of the entire GDP, but the representation of the most important aspect of the listed universe or the luxury premium organized market. Now look at it very carefully. Over post-COVID, our growth rate has been close to about 14%. Growth rate last 3 years has been 14% plus CAGR growth. But when you look at the top contributors, the top two, the growth rate has been much more stronger, right? IT and financial services growth rate has been very strong. But more recently, we have started to see that salaries and jobs in IT sector are dwindling. It is more a cyclical phenomenon, not a long-term phenomenon, or we don't have a clue for long-term, but cyclically they are slowing down, they're coming down. For financial services, if you note very carefully, last 5 to 6 years has been very, very kind. They have not seen any dry years, which is very uncommon for this sector, which is very, very capital market linked and volatile. And therefore, when you look at shorter term quarterly numbers, when companies report earnings, the possibility that this number will be higher in FY22 is very, very slim, which means that wages and salaries might grow at a slower pace than what they've been growing at 14-15%. And RBI recently came out with a financial stability report where it said that in most metro cities, inflation is running close to 10%, which means that if wages grow at 10%, real wage growth in this organized sector, which is a small part of the economy, will be close to 0%. And therefore, the ability of households, which is the largest contributor to India's CapEx cycle or investments, can slow down. Okay, this is a very big risk. And who is the other largest contributor? I showed you through the presentation, it is Government of India, right? And that contribution can also slow down because government will spend lesser money, lesser fiscal deficit. And now let me give you a 5-point summary of what we've learned in the last 6-7 slides. And then I will go on and show you 2 more slides on things which have gone well. There was post-COVID, there was a huge fiscal expenditure by all trade partners, which allowed India also to spend money. We spent that money more efficiently, focusing on capital expenditure, which revived this sector, which was in doldrums for 10 years. But the total expenditure is not extraordinary. It is cyclically peak, but not something that we haven't seen earlier. We have seen fairly better numbers ahead. Third, households, which are a very large kicker bulwark of this investment revival, are still missing. Can they make a comeback? Their balance sheets and salary growth says that it is less likely. That means they will have to work very hard, or there is a way out where the government of India spends a lot more money, which means that when the budget comes out in the end of July and government says that my revenue expenditure is going to grow by mid double digits, that will be a great news, which will tell you that this cycle can be broken, or the things which are possibly going in a slow lane can get revived because consumption will get revived. So we will have to focus on that. But as of now, it does appear that this cycle, when compared to 2003 to 8 cycle, is slightly inferior, while the market is treating this cycle similarly or even better when it comes to equity valuations for this sector or the sector overall. So you have to be very careful in picking which sectors or subsectors you're investing in. The next 2 slides are about what has gone in favor of India's balance of payment, because balance of payment has been a huge source of support for India. Post-COVID, if balance of payment was an issue, then Government of India would not have been able to run a very large fiscal deficit. So balance of payment has been a huge source of comfort. And what is the reason? 2 reasons. One, remittances. India has got huge share of remittances, and I have commented this in the past also, that India's greatest export to the world is not a commodity, it is people, because they send back hundreds and billions of dollars, and no other country sees such a high inflow of foreign capital because of its citizens who have gone out. So that $100 billion coming from private transfer remittances is a great support. Second, very large support comes from services exports. So India's services exports have dramatically improved from 80 billion to 160 billion over the last 6 years, over the last 5 years, growing at about 15% CAGR. But within that, there is a smaller category called business consulting, or you would have read global capability centers. So GCC, as you can see, their share has gone up significantly. Uh, it used to be in FY at 19% of overall services exports. They remained 19% till FY19 for 11, 12 years, no growth. And then in last 5 years, they've become 26%. What has been the growth rate? Business services consulting has grown at 85% CAGR, going from $700 million to $29.3 billion, and has become the fastest growing industry in the world. And that has been a huge source of support for India's balance of payment in the last 3 to 4 years. Uh, Additionally, as I said, remittances and services exports, which is software exports, has also been a very large, which is IT exports, has also been a very large source of comfort. Now, balance of payment has become, you could say, less vulnerable. That means we need a bigger monster to scare us today. The overall complexion of balance of payment has become much more robust, but it has not become immune. Okay, which means that India has not decoupled. It is still coupled, although the extent of problem has to be much stronger for it to impact India. And why it has happened that we are still coupled or still vulnerable to global shocks? Because in India, although on the balance of payment, we have started to get a lot of flows through our services exports, our goods exports continue to be miserable. They have not gone up. And FDI flows have started to dry up. In fact, in FY24, India received only $10 billion in FDI flow, or 0.3% of GDP, which is the lowest FDI flow that most out of the top 10 emerging markets that they have seen, right? And this has become a source of problem. And the reason is that FDI is a much more stable source of capital than FI flows, which are coming in right now, because they are much more volatile. FI's flows of 12 to 15 billion has been registered in secondary market and debt capital markets, which has been a big source of positivity for balance of payment along with the services exports. But this number where FDI, which has to go up and provide a lot more stability to BOP, has been declining, and which has kept our overall balance of payment still vulnerable. What does this mean? These last two slides mean that India is still prone to or open to a global shock. And what are these global shocks? For example, US changing its fiscal policy and capital flows drying up, or US changing its monetary policy, and because of exchange rate linkages, FI flows change their direction. Uh, Third, we tend to get less FDI even in the future. That could be a source of problem. These problems impact our monetary policy. These problems impact our FX exchange rate and therefore our economy. And it has happened in the past. In 2007, India was one of the most robust economy in the world. We had very large FX cover. Inflation was stable. Growth was one of the highest in the world. Balance of payment was very strong. We were running close to 1% CAD, which was very, very low. Fiscal deficit was almost absent, but just 2 to 3 months of very high FPI outflows and absence of FDI flows completely ruined our balance of payment and created a crisis for the next 2 to 3 years, for which Government of India had to respond by giving a very large fiscal stimulus. So those things can reoccur if this channel is broken in the future. And can this channel break? As I told you, there are 2, 3 ways in which it can break. One of that ways is purely political decision making, which happens in the developed economy. For example, in United States, where we have no say or way to judge when will it happen. Last slide is on our real interest rates. As I told you, our growth rates are going to slow down. Even RBI's own estimates tell you the same thing. Most other numbers have already slowed down, as you see, um, except our income tax growth, which is 16% CAGR over the last 5 years. Most other numbers, including GST, which might sound a little surprising, has seen a growth rate of only 11% CAGR, which is same as our nominal GDP growth rate or slightly lower. And that number is now shrinking back to 8% or lower. That means many nominal numbers are slowing down. Economy is slowing down from peak growth rate to maybe middling growth rate. But at the same time, our interest rates, real interest rates are significantly high. And these real interest rates, which are high, they discourage investments in the economy over a longer term, and they also hurt growth. Can we cut interest rates? I think most central banks are waiting for US to cut interest rates so that they are not caught off guard, and therefore they are sacrificing these precious few quarters and years to revive their demand, and therefore it might hurt demand going ahead because this precious time will be lost. And why is US not cutting interest rates? Because US consumer is very strong, right? And the Fed is saying that I don't need to fix what is not broken, so I'm going to wait until I see a crisis or I see very low inflation, both of which is absent in US today. In the meantime, most other central banks are running high real interest rate, which could hurt growth. Now, let me summarize and end the presentation because it has a lot to consume. First is, as I told you, no correlation exists between one-to-one correlation exists between economic growth and stock market returns. There are a number of countries, data points which can falsify it. The returns in stock markets are a lot more dependent on earnings growth of companies and the valuations that you pay for it. Second part, where we discussed fiscal expenditure by Government of India, I explained to you how a global fiscal extravaganza allowed India to spend that money, and India spent that money very carefully and very efficiently, causing a big buildup in our infrastructure and capital expenditure cycle. Can that capital expenditure cycle continue in the current form? It looks difficult because the balance sheets of households are stretched, and Government of India is also pulling back on fiscal deficit, and therefore it might put questions mark on sustainability of that cycle. Plus, real interest rates are not helping at the same time because they are chiefly very high. Last part, which I explained before this, is balance of payment. It has become a source of less worry for India because it has become much better than the past, but it continues to remain vulnerable because we have lost out on very strong flows, which comes in the flow of FDI, which have reduced over a period of time. To put everything in context and put a conclusion to it, the market believes that this is a 2003 to 8 kind of a cycle, although data, which I showed you just now, tells you that it may not be the case. The cycle is shallower than the 2003 to 8 cycle. It does not have the ability or support of global growth, which was a chief feature of 2003 to 8 cycle. And domestically also, government expenditure and household balance sheets are way different than they were in 2003 to 8 cycle. And therefore, we believe that this is the right time to be cautious about specifically about the narratives that are built in the market and pay a lot of attention to where valuations are. And I will, as a bonus, show you one chart, which is not in the presentation, on how price to earnings ratio is diffused around various market capitalization. If you see in mid caps, there are just about 20% stocks which are between 0 to 20 price to earnings multiple, or they are cheap. Rest of the market, about 80% of the market is expensive. And in small caps, about 75% of the market is in the expensive zone, which throws a large caution to investors that you have to be very careful in selecting stocks and focus on companies which provide you big margin of safety. So with this, I will stop here and we'll take questions. Pragati, back to you. Thank you.
Thank you so much, Sahil. We do have a number of questions. So starting with the first question. So why do you think, so on the definancial of savings, financialization of savings slide, why do you think that, what is the reason for the fall in financialization of savings? And also, we see the data around the SIP inflows being at all-time highs and retail participation. How do we correlate it to the fall in savings by households? And could these fund inflows taper off and make it difficult for the market to sustain since the FI and FDI inflows are already growing weak?
Sure. So first thing is that the question why net financial savings have fallen. There could be two reasons. One, that the growth rate X of the organized sector in income has not been very strong. Okay, so and that reflects in households borrowing a lot more money to consume. Okay, so if you look at bank credit data, you will find that loan growth in personal loans, MSME, and other, consumer durable loans is between 15 to 20%, 25%, while loan growth for large corporates is just about 5%. So it tells you that households are borrowing a lot more to spend money rather than their income, disposable income rising as fast as they should to support the consumption that they're doing. So net financial savings is a mathematical equation which is derived out of gross savings, which means that savings that you do when you put money in savings bank account or in time deposits or in stock market or in mutual funds, and then you subtract the loans that you've taken. Okay, that brings you the net financial savings. So the loan number has gone up significantly faster than the number for savings. And that is the reason net financial savings have gone down, which also shows up in the deterioration in the balance sheets of household. So I hope that clarifies why that number has fallen. Second, the SIP number that you correlated with that number, please know that the 21,000 crore SIP number that you are reading is a gross number. That is not the net SIP number. The net SIP numbers are still close to 6 to 8,000 crores a month. They are much lower because you have to account for redemptions. And redemptions happen on a day, although SIP happens over a period of time, right? So the adjustments are much more bunchy, or they come in patches. Second and more important point, we have always shown with data that flows follow returns and flows do not cause returns. It's a flawed logic saying that because money is chasing stocks and therefore stocks will give returns. It is actually the other way around. When stocks give returns for a period of time, lot more money chases those stocks in anticipation of making similar returns. And therefore, to the question, can these SIP flows come down? If rolling returns reduce, SIP flows will also reduce. Similarly, because if you look at SIP flows in a country like France or a Brazil or a China, they are almost non-existent because SIPs have not worked there because their historical track record is not as good as India. And therefore, it is a matter of time or it is a matter of chance that if returns do not fructify, these numbers will also be more volatile or they will also fluctuate.
Okay, so the next question is, since companies' balance sheets are showing historically low leverage, do you think it would allow some companies some space to borrow more and kind of mitigate some of the macro negatives we see right now?
Yeah, company balance sheets, of course, I think is in a fine health. I think they are much better than they were pre-COVID, and that gives them the ability to face any down cycle much more favorably than they would have prior to COVID. Okay. Now think about this, that if government balance sheets are in such a fine shape, why the private capex cycle has not revived? Okay, that is question number one. Maybe the large corporates do not see a large revival in consumption. Okay, so that could be one of the reasons. I'm just guessing here. I don't know what big corporates are thinking, but that could be one of the reasons. And big corporates usually are the first ones to foresee or anticipate or put money where their mouth is in expectation of consumption. And as you've seen in private consumption numbers, which form part of the GDP, the growth rate has been much more slower, right? So A, what you said, possibility is there that because balance sheets are much more robust, companies can do well and and create a revival in that sector. Yes, that possibility is of course open and it can happen, no doubt about it. But the conducive conditions for that to happen are two or three. First, low cost of capital. I think more or less cost of capital was low. Now real rates have become higher. So cost of capital has not really come down when growth rates are coming down. So that I think is a muddied equation. I wouldn't put it in the bad or a good side. Second, balance sheets, they are very robust. So it's a clear green tick, right, for the cycle to revive. Third condition, that consumption should make a comeback, that it should be strong enough. That is absent as of now. Can it get revived? Of course, it can get revived. Government can push and create that revival in the economy. But is it doing it right now, or is there a plan to do it? We will come to know in the budget. As of now, the last budget that we saw was not focused on that.
So the next question is basically a view on dollar. So if a rate cut happens, how is it going to affect the strengthening or the weakening of the US dollar? And say if the India's monetary policy is quite in tandem to what the Fed does, how is
Sure.
it going to affect our inflows? Also, following this question, there's another question that how do you think a rate cut cycle is going to affect the US market?
So I think the Federal Reserve has made it very, very clear that it is going to cut interest rates only if it sees problems, right? If it sees some areas that need to be fixed, then it will come and act. And that I think has created a clear messaging from the Fed that it will act only if there is a crisis. So I'm not very sure when will it act. Even if it does one or two interest rate cuts, it does not matter. 25 bips, 50 bips is not a large enough number to create any economic benefits. Second thing is, will interest rate cut by US Federal Reserve cause the dollar to depreciate or appreciate? I think that equation is not so simple, right? We generally simplify stuff. It's not so simple because currencies do not trade or change their direction based on what a central bank or a government is doing, but they also have to take into account what trade partners are doing, right? What will be the action of Chinese central bank or Eurozone or India or UK? That depends, that creates the possibility for dollar to do anything, go up or down. Given everything, everybody else follows what the Fed does, then I think the dollar may not depreciate as much. It might depreciate lesser if other central banks also follows the strategy that the Fed is doing. That is a possibility. And second thing is that Fed might actually create a consensus for most countries to devalue their currencies, and that which does not mean that there is going to be an event where central bankers come and announce a devaluation. You will not even know it, but it will be a tacit policy framework. If that happens, the biggest beneficiary will be gold, and you should be thinking about that rather than thinking about dollar.
Okay, so there's a view that the realty sector has entered a long-dated upcycle with projects dying of their shelves, especially the luxury projects. Inventories are at an all-time low. What do you think is playing in their favor?
So this inventories at all-time low is only true for luxury apartments. And if you look at data, which I saw in the morning only, the phenomena is not widespread. We have seen a very strong revival, of course, after a 10-year lull. So the revival has been very strong. But think about this way, that the revival is now settling at a growth rate which is lower than lowest growth rate of the previous cycle. Okay, so in the last cycle, in the real estate cycle, sales annually were growing at 20 to 25%. And the lowest year that we witnessed was around 10 to 12%. And so this year's best year is lower than the worst year of that cycle. So we've seen a cycle revival after a very long period of time, and therefore it does appear durable. Uh, but the magnitude or the impact of the overall cycle is more subdued.
So Sahil, basically we are at the kind of repo rate we are right now. And with so much like the credit growth being very strong, the deposit growth still lags, right? Now, how will banks continue to get deposit when the repo rate actually comes down?
So I think it's going to be a hard task for banks, and that is one of the reasons why banks are trading at, low or average valuations, while the other part of the market trades at huge premium, right? So market has been anticipating this problem, and that is why it is not giving any premium to banks. So sort of it is cooked into the price. Some of it, I don't know how much of it is cooked into the price, but a large part is already there. Second thing is that we've seen that with a lag, credit creates their own deposits, and over time, deposit ratio does make a comeback. And I think that should be the case even in this cycle. This cycle, it is delayed. Usually, we've seen that it plays out over a 12 to 18-month period. This time, I think it is delayed than even 18 months. So over time, I think those ratios will align as we move ahead. But those numbers are not only the nominal interest paid by banks on FTs, right? I think those numbers are still very high. Some banks are paying 7.5% even today, right? So it is not only a function of how much they are paying, it is also a function of many other things like households' propensity to take more loans, or competition for alternate assets, right? So if those things align, I think that growth will make a comeback.
I think that's it for all the questions that we had. Thank you so much, Sahil. Thank you everybody for joining. We'll close the call here.
Thank you very much. Thank you everyone joining.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.